Hey guys, on today's episode, I'm gonna actually be interviewed by the creator of LAZYFA.com. This amazing fundamental website that I use for my everyday activities in researching stocks. And no, don't worry, today's episode is not gonna be a paid, it's not gonna be some form of promotion for LazyFA. Chris is pretty much just asking me questions of my whole thought process on how I invest in a company, and I share some of my tools, some of my experience, and what I have done to make me the investor that I am today. So I hope you guys enjoy it. It is a bit longer, but I promise the information inside here is definitely worth it for new investors to investors that have been trading for a few years, or even long time investors who's been in the market for 7 years. I promise you there's something that you can pull out of this that will make you better. So take care guys, and I hope you really enjoy it. And before we go any further, guys, if you are a long-term investor, if you are new to my channel, and if you like learning about growth stocks, make sure to hit that subscribe button. If you ever want to get in contact with me, make sure to post on the YouTube comments. I am very active. I also have a very active Twitter, and I have a Discord channel, which is free to anybody that wants to join. Remember though, all of these are my opinions. I am by no means a professional, and all of this is free. So don't take anything I say as advice. Make sure to talk to a financial advisor, a financial professional, before making any investment styles. Finally, if you guys want to get into my weekly newsletter, check out josenaharo.com. And I'll have a lot of great information. And on this weekly newsletter, I am sending out my Excel spreadsheet where I do some form of valuation methods.
Tonight, guys, if you haven't been here before, if you haven't been to one of our streams, my name is Chris. I work with the Stock Market Live Chat. I'm one of the moderators here, and also one of the moderators on Reddit's Our Stock Market. And usually we do these streams like once a week or so. We'll do a live stream where we talk about a specific topic related to the market, whether it's scanning for trading ideas or conducting fundamental analysis or whatever. And this week we have with us a buddy of mine. His name is Jose, and he's Jose Naharo in the live voice channel. You'll see that he has a little live icon to the right of his name. If you click on his name and click watch stream, he's sharing his screen. Normally it would be me sharing my screen, but Jose is a up and coming fundamental analyst, I guess you would call him. He's a buddy of mine that I've known for a few years now, and we have been kicking around stock ideas on Twitter and via email and through my website, LazyFA, which he has up on the screen right now. And I've just been watching over the last 3 or 4 months. His YouTube channel has really started to take off, and the stuff that he's putting out there in terms of analyzing these companies using both my website as well as a whole bunch of other resources, it's just been really awesome to watch him sort of hone his experience. So what I wanted to do is just get Jose here, and basically I just wanted to grill him and I want to ask him questions about what his analysis process is like, and some of the resources that he uses, and so on and so forth. So yes, Stuart, by the way, the Twitch, because Jose is sharing his screen tonight, I'm not streaming on Twitch tonight. So in the live voice channel, click on his name and click on watch stream, and he's sharing his screen. So yeah, what we're going to do is I've got a few questions that I want to ask Jose, and he's going to share with us some of the techniques that he uses to analyze stocks, and some of the resources that he uses and the things that he looks at. And then we'll open it up to questions from you guys. So if you do have any questions along the way, what you can do is type in /question in the channel. This is a question. You'll see that little green check mark there, and that will go into the questions channel, and then we can come back to those at the end of the night. So Jose, do you want to say anything before we get started?
So first, I just want to say thank you, Chris, for having me, and to all the viewers that are watching. The whole purpose for this is I've been investing for some time,
And there might be something that you might be able to pick up from me. I'm not going to say I'm the greatest investor of all, but I've learned a lot throughout the years, and I do believe I could bring some value to you guys. So feel free to ask questions. And obviously, if I don't know the answer, I'm going to say I don't know, but I do believe I can bring a lot of value to you guys.
Yeah, I agree also. It's funny because I've been investing and trading since about 2003. And I didn't get real serious about it until probably like 2011, 2012 timeframe. But I've still been investing for a really long time, and it's been a hobby of mine for a long time. But I've never really honed my fundamental research process. And that's one of the reasons that I kind of wanted to selfishly like dig into Jose's brain, because like I see him releasing these videos like every single day. And I'm like, you're burning through this analysis like so quickly. And I find myself like sometimes I start researching a company and like I just lose interest in it, or like I just have like a good process, you know what I mean?
Yeah.
um so I kind of selfishly wanted to know how you're doing it.
And I think the
um
reason I'm able to produce, I mean, the content, obviously, we're going to see it's, I do about 20-minute videos, but behind there, I take hours and hours. And the reason I devote that much time is because I genuinely love reading, learning about new stocks or new companies and just understanding about them. So it's become more, it started off as a hobby, and now I think it's more of a passion.
yeah, that's how it all goes. And it goes from a hobby to a passion to a gambling addiction.
I think for me, it went the other way around. It started as a hobby, went to a gambling addiction, and then it became a passion.
Well, that's a good thing. So you're through the gambling addiction phase then.
Yep.
I've been stuck in that phase for like 10 years. All right, cool. So let's just start with a little bit of background about you, Jose. One of the questions that I have is, has your style, we've only known each other for like a couple of years now. So I don't really know, first of all, how long you've been investing. But I also don't know, was your style always fundamental? Were you a technical trader and then you changed to using fundamental analysis? Or, how did you learn that you prefer fundamental investing, and do you prefer fundamental investing? Like, are there aspects of technicals in your trading as well?
So first, I came out of college as an electrical engineer, and I started. Luckily, I started working with a nice paying job. And the first thing I wanted to do was, how can I make my money work for me? At that moment, I didn't know anything about stocks, so I picked up this random book at Barnes and Noble. It was this little guide to stock market investing, and that book opened up so many possibilities for me. So then I started investing. I made mistakes here and there, and that was about, I want to say, 7 years ago. And throughout the process, I have done all types of investing. I started off with first just investing in big blue chips. I then ended up trying to do trading. I ended up trying to do forex as well. I ended up trying to do options trading as well. I did fundamental technical trading, and every time I would try to do something, I ended up coming back to fundamental analysis. So to me, it told me, hey, these things might be fun the first few months for me, but at the end of the day, I always ended up coming back to really understanding the company and really understanding why I wanted to invest in them. So at some point, I stopped doing all those other types of training and just started focusing on fundamental analysis instead.
Gotcha. Okay. Yeah, because that's one of the things that I guess I never really got into it that much, which is ironic because I'm on a fundamental analysis website.
Which I
Um,
think is pretty weird. It's pretty funny.
yeah, and it from my perspective, I started out as a technical trader, and I went the other direction where I started with technical trading, and I kept finding these situations where I would get into a trade and it seemed like everything should have worked in terms of the technicals on the trade, but then it would just flop and I couldn't understand why. And so I started digging into the fundamentals uh, and looking at the underlying stories in these companies. And that really, the combination of those two things kind of took my trading to the next level where, before it was just reading charts and I didn't really know that much what I was doing. um, but it's interesting that you kind of bounced around and came back to fundamentals always. I mean, why do you think that is? Like, what is it about fundamentals that you're drawn back to, do you think?
I want to say just learning. I think the concept that kept me jumping around was learning about new stuff. So I would always pick up. I haven't read many books, but I would read a few books, and it would take me to, hey, options trading. So then I started learning about options tradings, and I feel just the aspect of learning kept me in there. And I feel like with fundamental analysis, you keep learning about a new company. So even though maybe I already learned about company A, there's thousands and thousands companies that I can keep on learning about. So just that drive of wanting to learn more about the different markets just pushes me back to fundamental analysis. Even though it might be boring compared to technical trading, where you might be looking at charts all day and trying to find patterns, I feel I just truly enjoy reading about a company and researching about them.
Yeah, and I mean, technical trading is much more involved. You're a lot more, and I don't mean more involved as in more complicated, but like it's actually probably the opposite, honestly. But um, you're a lot more involved in the process with technical trading. You know what I mean?
Yeah, and that's actually another thing. One thing with technical trading I found is something I needed to. Maybe it was just the way I was trading. I felt like I needed to be in front of the screen all the time and understand what was happening. And obviously that for me, I didn't find that enjoyable. I like doing my fundamental analysis, and when I look at a stock or a company, I'm looking for long term. So noise that happens within a week is not something that's gonna change my opinion. So that's something I enjoy. It's that calm of mind and not having to really keep looking at news, looking at the charts or anything like that, and allows me to just live a normal life as well.
Definitely. I found the same thing when I was, really wrapped up in technical trading a lot. Is I had my life was staring at charts and being at my computer all day. Um, so I started selling options premium to alleviate that issue, right? Because you can sell weekly option spreads and you just wait all week long and they expire on Friday and you roll them to the next week or whatever. You close out your trades and you open up new ones that expire the next Friday. That really opened up a lot of time for me.
Yep.
Um, yeah, I mean, the technical trading you're like there all the time and you have to be all the time. Even when the market's closed, like you're scanning for ideas and you're flipping through hundreds of charts just to find, the 10 that are going to go on your watch list the next day. So,
But it's funny, right? At the same time, at the end of the day, I'm still here almost all day just researching about new companies. But so I guess I just
at least
enjoy
you're
it more.
learning, right?
Yeah.
Cool. All right. So you alluded to this earlier. How we only see like 20-minute videos on your YouTube channel. And guys, if you haven't seen Jose's YouTube channel, just look him up on YouTube. It's Jose Najarro, and I'll throw the link into the chat as well. I've got it up on my end here. He releases these videos like almost every day, right?
Yeah. Oh, I try to do on a daily basis. If not, it's five, 6 times a week.
Yeah. Okay. So we see these completed 20-minute videos, but anybody who's ever done live streaming or webinars or any kind of video editing knows that to create a 20-minute finished video, it's probably like 4 hours of content edited down, and then 2.5 hours of editing. So how long does it take you, before you know whether or not you should invest in a company? Like let's say that you're starting a brand new research process on a new company.
Mhm.
How long does it take you? How much time are you investing into this behind the scenes?
So it definitely depends. First, it depends if it's a market I know about or if it's a market I'm not familiar with. For example, I don't know, my portfolio, I have about 40 to 47 positions. And even though a lot of people might think that's a very diversified portfolio, those 40 to 47 positions are really broken down within 7 markets. So first, what I start off is is starting to understand a market I believe might see growth. So for me, the first market was esports. I do believe that esports, and so one of those markets I'm in is esports. So I start off just pretty much a top level, understanding the overall market, where the customers are coming from, and then after I understand the market and I understand if there's some growth in that market, or I just feel like there's some, because at the end of the day, I do believe there is some gut feelings that need to go with it. If my gut's telling me yes, this is a market that's gonna continue to grow, there's data backing it up, then I start looking at the top dogs of that market. And then that helps me select more companies to, hey, maybe this might be company that I want to continue to look in. So the first thing I want to make sure is the market a market I believe is going to continue to grow. If the answer is no, I automatically put that company in the no pile and I don't take a look at it. So it's a lot easier for me to decide if it's a company I don't want to invest in than it is if it's a company I want to invest in. Because if it
So,
Mhm.
so you're starting sort of at the market level then.
Yeah. So like I said, I start off with the market level, and then after I found those markets, like I said, I have 7 markets. Then it's a lot easier to go from there.
Yeah, yeah, of course. Okay. So let's say you get to that point and you've got a couple of companies that you are going to put up against each other in one of your videos. Like you do those Monday matches or whatever it's called, right? Where
Yeah.
you take two companies and you put them against each other and you figure out which one's better.
Yeah.
Um,
Mhm.
how
So
does that work?
like you mentioned, right? First, I find companies within a market I believe are is going to continue to grow. So I find a few companies within that market, and the first thing I want to understand is, do I understand the product? Do I understand what they sell? And do I understand their customer base? And the first thing I would go is pretty much just go to the company's website. I feel like that's the best place to go. If you can go to their website, if you can go to their products and understand what they're selling, you already are ahead of the game, because now you understand what can go wrong. If you understand their products, you can understand what can go wrong with the market or what can go right. So now that after I find out their products and I understand the company, then I start looking at I start using two platforms. I use obviously LazyFA to take a look at historical data. I want to see, hey, how has this company done in the past? Has it shown revenue growth throughout the past 3 years? Has it seen profit margins increase the past 3 years? Has it seen what kind of debt does it have? What kind of assets do they have? And then I also use another platform, which is Simply Wall Street, and this one I use to take a look at future growth. They have a lot of estimation on how the company is gonna do within the market, within its industry. So now I'm like, okay, this company did well in the past. It has a good level of balance sheet, and if we want to break that down a little bit more later on, we could. And then I also like that, hey, the market is showing that this is a business that's going to grow faster than the market and is going to grow faster than the industry. Because to me, there's no point in investing in a company that's going to be slower than the market. If it's slower than the market, I might as well just invest in the overall market and ride that wave.
Yeah, yeah, of course. Makes perfect sense. Um, so Simply Wall Street, I've looked at it before. I've never actually used Simply Wall Street, at least not their paid version. Do you actually pay for it or do you use their free features?
So I started off with their free features, but then I moved on to using their paid service.
Gotcha. Okay. Do you think it's worth it?
For someone who's actively looking for new positions, I do think it is. Um, but
I'm
like,
just curious, by the way. I'm not,
yeah,
I'm wondering because I've poked around in it a little bit before, but I've never personally used it for anything in my own investing.
but they do have, like you mentioned, a free version which is for 10 stocks a month. And like I said, if you think 10 stocks a month is more for you, then that's fine. But for me, when I'm looking at new companies, I sometimes go through 15, 20 in a week or two. So that the
Gotcha.
free feature wouldn't have worked for me.
Yeah, at least not at this point. Cool. All right. So you've talked about this a little bit. do you have a you must at this point, right? Because you're making videos almost every single day.
Mhm.
You're doing this kind of research every single day. So you must have started to develop some sort of a routine. Um, is that kind of what you were talking about in your answer to the last question, where you start at the high level and then dig down into the individual companies, or do you have? Can you elaborate on that at all?
Yeah, so let's if maybe it'll be better to show an example, right? Let's just start off with Apple. So
Yeah,
I'm here
definitely.
on LazyFA, and my favorite feature. It's funny. My investing style continues to the investing style that I have now is probably not the same I had 7, even 8 months ago, even last month. I continue to develop and I continue to learn, and that has helped me with LazyFA. At certain times, I used to use the dashboard, and now every time I develop my investing career, I continue to find different things that I use. Now, my favorite one is the red flag analysis. And let's take a look at Apple. The first thing I start off is go to look at their income statement, and I take a look at revenue growth. So I take off cost of revenue. I'm seeing here revenue growth. So for me, I really am. Many people would consider me more of a growth stock investor, but I'm just looking for a company that's doing well, that's going to continue to grow. And I think every investor should be really looking for that. So for me, I'm looking for companies that are growing revenue at least maybe 10% in the past year. So I would start looking here at Apple. So Apple in the past year has, and actually let me take a look. I usually take a look at trailing 12 months instead of yearly. So I start off first. The first thing I want to take a look at is just how their revenue growth has been going. Right. So now after I take a look at their revenue, I if I like it, I continue. I start looking at their gross and profit margins. What I'm looking for in their gross and profit margins is there an improvement going on in profit margins? Are they decreasing in their profit margins? What is happening throughout the years? And actually, let me take a look at one of my current growth stocks so you guys can see how. So one I'm looking at right now is Celsius. So if I go, let's just start off with Celsius. And we go to the income statement in the red flags.
For some reason, it takes longer when you don't let that home page finish.
So here we can see, right? This is a company trailing 12 months, period to period. Sorry. This is in the past year. It grew in the past trailing 12 months. It grew 61.4%. In 2019, in between December, it grew 42%, 39%, 49%. So this is a company that excites me, right? We're already seeing that revenue growth. So now I'm like, okay, this company is growing at a nice pace. Let me go on and proceed and take a look at profit margins. Normally, for me, when taking a look at growth stocks, you have to understand what stage the company is in. Is it in a stage where it's growing revenue at a fast rate, or is it a company that's pretty stable right now? And that determines a lot. If it's a growth company, what you normally are going to see is for the previous years, you're going to see negative profit margins, as companies during this stage are really focusing on acquiring more customers, on using research and development, and just marketing. So you got to really understand what stage that company is to really understand what you're looking at. So the first thing I notice is, yes, Celsius has had negative profit margins, but there seems to be an uptrend. And in the most recent year, it actually did provide profitable margins. So now this is okay. This is a company that's growing fast in revenue, and it's also improving its profit margins as the years go on.
And it's significant, right? Because they have not only been improving their profit margins, but they've flipped from effectively losing money to making money.
Exactly, and that's a big change right there.
Yeah. So if you click on quarterly there on that profit margin chart, what quarter did that occur in? So it looks like they have a big spike there in early 2019.
Mm-hmm.
So this is, I know that this is not about my process, right? But one of the things that I look for when I see stuff like this is I always want to go, when I see a big spike in, the
Yep.
annual
Hmm.
changes, I want to know which quarter it occurred in. And that big spike in early 2019, right, is a not necessarily a red flag, but a it's an indication that I should probably look at the SEC filings, right? Look at that 10Q or that I guess it would be a 10Q at that point. It might be a 10K depending on which quarter it is. Um, but there's probably going to be a footnote in there if they have gone suddenly from, one quarter being negative 5% net margins to the next quarter 80.5%. Probably going to be a footnote somewhere in the SEC filing that explains that, and that'll give you a little bit of insight as to you know what caused the change.
Agreed. Yeah, and that's one of my favorite things about LazyFA is when you see a big change like that. The first thing I would do as well would be that quarterly change to see where that spike happened, and then when you can click here, you can see the 10K or 10Q report. But then also, if you're and you can see maybe it might be a tax benefit that it collected. It might be some form of settlement that it went through. So the 10K report or the 10Q report would give you a lot of information from there. But even if you're looking right at the 10 quarter report, you can see on average the profit margins have been improving compared to the previous years as well. Even if we don't count that 1 year.
Yeah, definitely. They've been getting closer and closer to zero, and you're seeing more, flips between positive and negative each quarter, as opposed to like back in 2014. If you look there, it's consistently like minus 25, 30%.
Mhm.
Cool.
And then
Okay.
after this, like I mentioned, it's very important to understand what stage. Well, for me, it is very important to understand what stage the company is in. So for me, I would consider Celsius right now a growth company that is making barely any money at the moment. So now, when I take a look at the next page, when I take a look at the balance sheet, I become a little more strict in what I watch. I have to make sure if they're losing money at the moment, I have to make sure, hey, do they have enough cash to survive for X amount of years before becoming profitable? Opposed to, hey, if it was a company that was already profitable for certain years, I would be a lot less strict on their balance sheet because I know they're already providing income. Just the best way I think the balance sheet is I think of my personal finance. If I had no job at the moment, if I was just working on some form of business, I would prefer to have a lot of cash right now and very little debt because I know I won't be making any money soon. But if I did have a great paying job, it would be okay for me to have a mortgage. It would be okay for me to have a car payment, a car loan, because I'm bringing in money so I can pay my debt. So that's pretty much exactly how I look at the balance sheet. I try to figure out, are they making money right now? If so, I can be a little less strict on them on the balance sheet. If they're not, I have to really be focused on what cash or what kind of assets they hold compared to their total debt.
Got it.
So for here, let's take a look at quarterly for Celsius. So the first thing I pretty much take a look in just quick assets at the moment. So first, I just want to take a look at cash and cash equivalents and any form of current investment. And that to me tells me quick cash that they're able to use at the moment in case of any downturn. So any current, they have about $19 million of cash and cash equivalents. And now let's take a look at current debt. They have about $9 million in current debt. So even if something bad happens, in theory they still have 10. They have more of a 2-to-1 ratio of their cash and cash equivalents compared to current debt, even to total debt, because their non-current debt is about $200,000. So it really depends on what stage that business is and how I really take a look at their balance sheet.
Yeah, because I mean, this company, if if they wanted to just burn through all their cash, right? They save $1 million in the bank, leave $1 million in the bank, right?
Mhm.
They could pay down, their entire current debt, their entire non-current debt, and about half of their accounts payable, which is a significant, that's a good position to be in.
Agreed. And then, like I said, before I even started, I got to this point, I first tried to understand the market that Celsius was in. So before I even started looking at them through their for their historical numbers, I try to understand the market they were in, and I try to see if this is a market that I believe will continue to grow, if this is a product that I see a future in.
What is this company anyway? I don't know what they are.
So Celsius is they are energy drink, um, and they're more of a of a healthy energy drink. And I was just looking at their 10Q report and their earnings report, and they are just starting to come out in big stores like Target. They're just starting to come out in Walmart. So and that's why we're seeing that huge growth in their revenue when we took a look at trailing 12 months, because they're getting these big orders from these big boxes that are just coming in. So normally I don't invest in outside. Most of the companies I'm in are usually tech stocks. This is one of the few that I have invested that's outside a tech type product.
Yeah, yeah, I noticed that too. You're very focused in the tech market and very focused um in the like sort of new age industries. Um, at least that's what I've seen from your videos, right? Like solar energy and clean energy and high tech stuff, right? So yeah, this is an interesting one for me after watching some, you know, most of your videos.
Yeah, yeah. It's and to the end is at the end of the day, I don't ever want to put a true block on myself on what I can invest or what I can't invest, because I feel the moment you close yourself off, you're gonna start losing opportunities. So as long as I can understand that market and understand where the product is going, then it becomes an acceptable company for me. Most of the time, it tends to be a tech stock, especially in the either in the e-payment, e-commerce, e-gaming type. But there are certain times when I go outside those realms. And I think that's what's helped me out a lot. It's not closing myself. It's, for example, I would consider maybe myself a growth investor, but I learn and listen at other types of investors as well. I go and listen at maybe people that consider themselves value investors, people that consider themselves dividend investors, because even though their investment style might not be the same as mine, I do believe there's something I can learn from them that I can use in my investment process. And throughout that, that's it just helps me continue to become a better investor.
Yeah, absolutely. 100% agreed. Okay. So you, so let's say that you don't know anything at all about a company, about the market that they operate in, about their business model. What's your this is something that I struggle with a lot. Like if I just recently, right? Like I started looking at Vroom, VRM,
Yeah, I
and
feel like
then
I've heard of them.
Vroom, and then there's what's the other one? Carvana, like the two big ones, like e-commerce auto sales. Um, it's yeah, so it's VRM and yeah, Carvana is the other one.
Hmm.
Um, so these I think are like the two juggernauts of the industry. Um, but I don't know anything at all about buying and selling used cars online. So put yourself in that situation, right, where you don't know anything at all about the industry that you're investing in. You go on to Reddit and Seeking Alpha and Twitter, right, and you're seeing all these people, like every single idea you have, somebody contradicts it, right, because they're like super involved in the industry and they know everything about it. Um, how do you get to the point where you feel comfortable with the decisions that you're making on these trades? Like,
So
what's the thing that you would do in order to like really dive into the industry and start to learn the depths of these companies and you know how to analyze them?
so let's say I don't know much about Vroom and the overall online market for cars as well. So for let's say if I wanted to learn more about Vroom, and now just searching Vroom, I already found one of, like you mentioned, one of their competitors would be Carvana. So what I would first start off is I would start off by looking at their investors presentation. And I do believe their investors presentation they show a lot of information about the overall market. and I would try to look at Room's investors presentation, and I would then take a look at Carvana's presentation and see, hey, are both these companies seeing the market, not their market share, but just the overall market the same way? Do they believe, is there any contradiction between them? If they both show that, hey, they're both showing the overall market is expected to grow, then okay, that would be my first step. Then I would just continue to look from there. And let me try to think what I would do next.
Yeah. So one of the things that I do, right? It makes me happy, first of all, to hear that the first thing you would do is go to the investor presentation, because that's exactly what I did. So, now I've at least self-validated what I was hoping for. Because one of the things that I used to do, and I still do this sometimes, everybody says, right, you got to go to the SEC filings. You have to read their annual report. But man, some of these annual reports are like 200 fucking pages long.
Yeah.
So, like, by the time you're done reading the annual report, you're like, well, I spent 3 weeks reading this book about Vroom. Now I'm like totally burned out in researching the e-commerce auto sales industry. I don't even have the mental energy left to go and look at Carvana or any of the other competitors. Um, so to me, going to the investor presentation was sort of like, that's what the average person would do. Go to their website, check out their website, maybe Google some of their competitors, look at their investor presentations and things like that. Beyond that, where do we go? You know what I mean?
Yeah. So then after that, now that I've been thinking, you got to understand that there's also people out there that 100% know more than you. So I've used. I don't have many social platforms, but one that I found very useful has been Twitter. And Twitter, I follow probably about 100 different people, and all of these are just investors. And I'm using, even though it's a social platform, I'm using it for positive, where they're sharing their thoughts, and I'm reading through their thoughts. So in Twitter, you can actually, you can search, for example, a room, or try to find some investor that might be talking about this company for some time. So now you can start to at least start looking at the good points of the company. Now, once you're all happy and taking a look about the good points, then I would start looking at articles. And these articles, I'll be mainly looking at bearish sentiments. So I'll start to find bad points about the company. So now that I have both good points and bad points, now I can start looking at their fundamentals, at their past history, to see, hey, has there been any, does this person's bad point make sense to me? Is it something that, if I would have looked at it without him telling me, is it something that I would also agree was a bad point, and go on from there and just continue?
Got it. Yeah. So I love that. The fact that you are actively going out and looking for contradictory opinion, as opposed to uh, looking for someone who validates your opinion that you already have.
And the reason I believe that is because when people usually, most of the game is usually very bullish. So for someone to be very bearish into a company, it means that they feel like they know something that you don't know. And they might have found something that I did not know. So I want to read through it and see, okay, this makes sense. Or, yes, I understand what this person means, but at the end of the game, I don't believe it will truly affect it.
Yeah. Yeah, definitely. Okay. Cool. All right. So I think we've gone through, we kind of mixed a couple of these questions together, but one question that I had is, if you had, so you've talked about how you use LazyFA and how you use the investor presentations and the company websites and so on. What other resources do you find? And you mentioned Simply Wall Street as well. What other resources do you have? Like, I see you using Seeking Alpha and stuff like that. I don't really use a lot of those types of resources. So what do you use for things like reading SEC filings, um, your news sources? What are some of the resources that you would recommend to someone who's newer at this?
So the first one,
And it's gonna sound cliche, but obviously the first one it would be LazyFA, and that to me is it's the name is exactly what it does to me. It's lazy fundamental analysis for me. I have a full time job, and for me to be able to look at to go and just look at this, especially not only the current values but the trend of the graphs compared to the previous years is the biggest time savers. I can go to a lot of free websites that will give me the current value, but I need to know how it fluctuates throughout the years. So this has saved me a lot of time, and it's what allows me to really go through this process. The second resource, like I mentioned, would be Twitter, and I think that one is number two because I'm an engineer, so I don't have people within the field that understand that really have had their foot in the game or have skin in the game. So with Twitter, it allows me to follow people that have been in these shoes already, so I can directly learn from them. So that would be my second one. My third one, I want to say is just Google and whatever company I'm taking a look at is the investors relationships website. You can find from there. You can take a look at they have their 10Q report, their 10K, all the reports, all the filings, all the presentations, all the updated news. So their investors website would be number third. Number four, I like Seeking Alpha, but I don't think it's one that is a must for me. So Seeking Alpha, the way I use Seeking Alpha is for the following reasons. Let's say I was taking a look at AMD. I mainly use it for this reason of just getting all the news because I'm pretty sure they're just pulling news reports from different sources and they're just putting it here. So here I just take a look at recent stuff from Seeking Alpha to get to know what's really happening around. So it's more for news articles that I'm using Seeking Alpha. The other reason I'm using Seeking Alpha is when they post earnings. If you go to their earnings, I like to look. They kind of, instead of me going through the investors relationships website, I can pretty much just easily click here, press relationships, 10Q report, transcript, or the presentation slides. So it just saves that time.
Oh, nice. Okay, so that's all for one specific release, that Q1 2020, the press release, the 10Q, the transcript for the call, and then the slides for the presentation.
Yep, and usually Seeking Alpha, I only use them for when I already know about the company and I just really want to know about updated news from them. But I think if you want to take a look at past, oh no, you can actually look at past information as well. I thought for past information you had to pay. But yeah, this is normally I do for a company I already know a lot about, and I'm just doing an update on their earnings. So I would jump into Seeking Alpha. Another thing I would use them is, like I mentioned, I use Simply Wall Street for the revenue growth, but here you can already see revenue estimates for the end of this year and for the end of next year. So it can show me, hey, this is a growth company that's going on and proceeding from there. And nice. The fifth one, and these are actually in order. The fifth one would be Simply Wall Street, and let's see if I have here. Let's go to stocks. Simply Wall Street, the way I use it, let's go back to AMD. The only main reason I use Simply Wall Street is for their future growth tab right here. And it kind of gives me here, this is the only thing I really use it for. It tells me annual earnings growth. It tells me AMD is going to be a company that for the next 3 to 5 years, on average, every year will grow 35%. So it's going to be both the industry and the market. It's also a company that's going to be the market and industry in revenues, in earnings, in revenue growth. So the first one was earnings growth. The second one was revenue growth. Actually, there's another reason I use it is I try to look at their ownership, especially with growth stocks. I want to see that, hey, are the insiders a huge portion of ownership? So usually, for example, let's take a look at Spotify, which is one I really like. If you take a look at their ownership, it tells you really quick, hey, individual insiders own 20% of Spotify. So
All right.
that to me is pretty impressive. Um,
Yeah.
and then the other reason I use Simply Wall Street is they have a screener where you can go and uh, it's a no discover. So in discovers you can look for companies that are gonna grow at a higher pace. So here I want to take a, let me edit the screener real quick. Maybe I just want to take a look at tech stocks. So give me 1 second. So let's just do software. So now it's showing me all the companies that for the next 3 years are going to be growing earnings. So then this, I start looking, and this is pretty much my how I start my process. I look at these earnings growth and I start looking, hey, is this a company I like? Nope, maybe this one. Nope, maybe this one.
Right. Nice. Okay, so all of these are in the same sector, I guess, right? In the software sector or the
Yeah.
software industry.
All of these would be in the software sector. And then again, I tend to just stay in sectors I know about.
Mhm.
So I have to make sure I filter my industries.
Cool. I think let me look at my list of questions here. I think I think you've pretty much harped on lazy FA a good amount, so it's probably pointless for me to ask you how you use lazy FA in your research process at this point. um,
I use it for pretty much everything.
yeah, no, and honestly, like guys, we didn't plan this beforehand. I sent Jose the questions ahead of time just so that he could have a look at, what I was planning to ask, and think about it a little bit, just so he wasn't put on the spot. And this is also the first time that we've done this, so we wanted to sort of be prepared and make sure that we're adding value to the room. Um, but I think that's all the questions that I really have. Other than just to finish up, if you had some advice, for someone who's just getting started with fundamental analysis, right? There's always new people. People are going to be overwhelmed. There's tons of information out there, right? It's easy to get information overload and end up with, as my trading mentor used to say, paralysis by analysis. Where you just get stuck so deeply into the information that you just don't. Everything that you look at, something else contradicts it, and you just end up not making any decision at all. Um, how do you combat that? Like, what would your advice be to someone who's just getting started with fundamentals or with researching stocks in general? How do they keep from getting overwhelmed? What's the first thing that they should do?
So the first, I would say, which would be pretty weird, just go ahead and try it. I mean, I think the best teacher at the end of the day is experience. And whenever you come into the market, if you're new, just come in with an open mind. Don't block yourself because you believe someone else's investing style is not for you. So first, I want to say just come in whenever you talk to any investor, even if they have had less experience than you, if they don't have the same amount of time or don't even invest the same way as you, don't block them off right away. Try to see why they invest that way and try to pick up from them, because everybody has something to teach you. So just first, just start learning, just start grabbing and learning information from others. And the second thing, one thing that I didn't mention here is understand your risk tolerance to the market. And I talk about this a lot in my videos. And to me, risk tolerance means that whenever I go to sleep at night, I'm not worried about my portfolio. And there's certain steps that I do that help me with this risk tolerance. And the main difference between every investor is they have different emotions. One of the ways I help control my risk tolerance is by having 40 to 47 positions. But that doesn't mean that maybe someone can have a 10 portfolio position. There's no perfect way to invest in this market. A 10 position portfolio can do as great as a 5 position portfolio. It can do as great as a 20, as a 30, as a 40. We see big ETFs like the ARK investments who are destroying the market with a 47 position portfolio, 48.
So never just don't get stuck that there is a perfect way of doing this. There's no perfect way. Just do what you feel comfortable. Whatever helps you not whatever helps you sleep at night is the best way to continue going forward. Because if the moment you have emotion in this game is the moment you really start to lose money. Because if you have too much emotion in this game, you're gonna start selling at a loss. You're gonna start having weak hands when the market drops 10%. When the market drops 15%, you're gonna lose so much money. So, for example, I might be rambling right now, but in this big drop of March, of when we had this March sell-off, most of my positions I did not sell. I didn't even touch. There were a few positions that were telling me I had to close out of them. And those were the positions that I did not feel comfortable the amount of research I did in them, or that maybe I was too overexposed to them. And those are the ones I ended up trimming off. So that helps me understand, hey, Jose, if maybe a 7% portfolio percentage holding is more than you can handle. But again, for every investor is different. Some investor might be okay holding 25% in one stock.
Yeah, yeah, absolutely. And I think that's super important, especially in this industry or in this market where everything seems to be driven by tech. Um, you know, if you were investing in the Nasdaq back in early April, you're a very happy camper right now, right? Because you've gone from 170 on the QQQs to 270 in like a month or 2 months.
Mm-hmm.
Um, Now, with the entire market being based on that rally, and the S&P 500 and the Nasdaq being made up, so much by these big companies like Amazon and Google and Apple and so on. If that one industry takes a dump, you're going to feel it a lot more than
Yeah.
somebody who has 47 positions, like yourself, as long as they're not all in tech.
Yeah.
Cool. Yeah, and I think that's super important. The risk tolerance aspect of it, and also just managing your emotions in general, especially with if you're going to be a more active trader. Um, you know, Managing your emotions is absolutely key. When you start to get emotional, you will absolutely make shitty decisions, and you will lose money. So definitely.
Yeah. So that to me has always been my number one thing is understand your emotions in this. And I feel like you mentioned it can go for long-term investors, it can go for active investors, it can even work on traders. You just need to really understand your mentality in this game and how much you can really what you can really withstand emotionally.
And I think, the other important thing about fundamental analysis, I've seen a couple of people pop up in the chat asking questions about fundamental analysis and technical analysis. For me, knowing a little bit about the company actually solidifies my opinion on the technical aspect of it. I'm going to feel a lot more comfortable investing or trading, even if it's just like a week long swing trade. I'm going to feel a lot more comfortable swing trading something on almost a completely technical basis if I know that I'm not going to get smacked with crappy earnings on day three because I have looked up, when their earnings release is or whatever. And I don't know anything at all about the company. Like there's been companies in the past that I've traded for like multiple months, and I thought that they did something totally different than what they did because I was just basing like what I thought they did on like the ticker symbol. Um, and I can't think of any examples off the top of my head, but like Lake, for example, Lake is a biotech company. They make hazmat suits, but you would never guess that from the ticker. And
Yep.
it's easy to get sucked into, trading the same stock day after day after day after day when you're an active trader or a day trader. And you think these companies do something different, and then you find out like they're not actually a biotech stock; it's a tech company. And for me, knowing the fundamental story of the company actually solidifies my opinions from a technical perspective. And I'm sure it works the same way going the other direction, right? If you do a bunch of research on a, on the fundamental story of a company, and you find that fundamentally it's solid, they have, nice revenue growth and good profit margins and so on, and you find that it's a good investment, but then you also look at the chart and you see that it has like a perfect technical breakout pattern, then that just adds another piece to the puzzle.
And I do think that's something I need to continue to learn, to add. Sometimes I mentioned it in my recent video that I posted today. This I don't have unlimited funds. I pretty much like mostly probably everybody here, I put money in the market on a weekly basis whenever I get a paycheck. So for me, my main way of investing is dollar cost averaging. So with dollar cost averaging, I'm pretty much I want my money to work right away. So I'm usually buying, maybe sometimes I might be buying at the high, sometimes I might be buying at the low. But maybe if I maybe practice my technical analysis a bit more, maybe I can kind of protect myself from, hey, buying at the all-time highs, or maybe buying at that peak level, as we saw this past week. I think Fastly has been one that is down 26% from its all-time highs.
And I mean, look at look at Tesla, right? The elephant in the room. Tesla goes to $1,700 a share after hours when they release their earnings. Everybody is surprised when it drops 20% over the next 2 days,
Yeah.
because it had already gone on a 70% rally.
But then at the same time,
So
it can go the other way. For example, Spotify. Spotify is one I was looking at when it was $150. And that was the peak at the moment. And I'm happy I went into Spotify at the moment, because look at it now, it's at 270. So that goes with that risk tolerance. You got to understand, how much are you willing to risk? If this company drops, if this company goes up, how are you gonna? Which one are you gonna regret more?
right. Yeah, definitely. Okay, cool. So let's do you have anything else that you want to add before we get to the questions from people in the chat? There's a bunch of questions from them, so I want to make sure we get to them.
No, I think I'm good from there.
Okay, cool. So me to read these off. Are you looking at them in the chat yourself?
Yeah. Let me see. Where would we start off with?
We can just make it conversational. I can just go through them.
Sure, that would be awesome.
Okay. So the first one is from Ludders. He wants to know, or she wants to know, would you say it's best to focus on researching one industry at a time? Pretty straightforward question.
Yes, I would say yes. It's like you were saying, the whole paralysis analysis. Even if you start focusing in too many markets at the same time, you might just be overwhelmed. But because once you find out about the market, you can just move on to the new market, and you can use that experience you learned about the first market, of how you went through that process. It makes looking at a new market a little bit easier. So I think even in a time point, by doing the first one first and seeing how you collected that information, now when you take a look at the next market, it's going to be a lot faster. The third market is going to be even faster than that.
Yeah, absolutely. So you sort of hone your process on that one industry, then you repeat the process on different industries. And that, I think, makes it easier to see the differences between those industries too.
Definitely, and sometimes some of those industries might connect with each other. For example, I am very bullish in semiconductors, and the reason I'm very bullish in semiconductors is because I'm also very bullish, and because they provide all these the components, all these infrastructures for these big cloud market companies like Google, Amazon, and all this. So by me being bullish in the cloud market, it also kind of makes me bullish in those that provide the supplies for that market. And who are those? Those are the semiconductor companies. And then from there, I can even keep working. I'm like, so maybe who are the ones that provide the stuff from the semiconductors, and I can work my way down the list, and I can find different markets that I might have never heard about.
Yeah, yeah. So I can see 100% how that turns into a rabbit hole that you'll never get out of. Um, and that's why you're releasing videos every single
Yeah.
day on YouTube.
And like you said, it could end to a rabbit hole. Eventually, it gets to a point where it becomes maybe too technical for my brain to understand what that market really is, and that's where I end the line. When I no longer can understand that market is when I draw the line. And pretty much going with that example, right? The clouding company brought me down to semiconductor companies. Now in the semiconductor companies, it shows me there's big improvements in the esports and the gaming industry. So it made me go and look at the gaming industry, and then from there on, it just continues, and it builds my overall sector portfolio.
Yeah, nice. Okay, so next question here. Do you think technical analysis reveals the fundamental analysis? Does the graph show all the emotions?
That I wouldn't know that one.
That one might be a question for me, actually. Oh. Do I think I don't know if technical analysis reveals the fundamental analysis. I think they're personally, I think they're separated. Um, I think that technical analysis shows the emotion, and fundamental analysis shows you the reality.
And I agree with that. With especially, and one great example right now would be Intel. Intel just dropped 16%, and I took a look at their fundamental analysis, and when looking at their most recent earnings and everything, I felt like it was more of a emotion that these investors are feeling right now with this anger with Intel, and just the type, because what's happening with Intel, it's something that has happened in the leadership previous quarters as well. So to me, it's just showing me that, hey, investors are showing that, hey, we've been down this road before with you, Intel, and we're not gonna take it. So it shows that emotional feeling that investors have within a company. But I don't know if that's the case for every example. But I want to say for Intel, it does show that technical chart shows that emotion from investors.
Yeah, absolutely. All right, one other question. Someone wants to know, what do you think about Chinese stocks? They said they're heavily invested in Neo and want to know your opinion.
So with Neo, I have no opinion. That's a company I haven't really looked at. But with Chinese stocks or just any international stocks, it goes back to my risk tolerance. Understand that when investing in an international company, there is international risk. And within those risks, you have to work your portfolio to how much risk you're willing to take. And usually I wouldn't say the great thing, usually the stock market, in most time, people are going to say Chinese stocks look amazing. They're a lot cheaper than United States stocks, but that's because they contain higher risk. So within that higher risk, they're going to be a bit cheaper. So just understand your overall. I personally am invested in Chinese stocks, but I don't think Chinese stocks hold more than maybe 15% of my portfolio. I wouldn't even say 10%. I think maybe 10%, because Huya is one of my biggest investing, and that's about 7%. But I invest in Chinese stocks. But again, I understand the overall situation that they have international risk. And for that reason, maybe my whole portfolio will never ever be Chinese stock. Maybe I have a devoted portion on them.
Yeah, of course. That makes sense to me too. And Lutters, to answer your question, from my perspective, um, I agree with Jose. I think it's important to understand the risks, because not only is there international risk between, um, with respect to like currency rates and so on and so forth, and tensions between the different countries, but also in the fact that the Chinese system has different accounting standards. So when you look at the fundamentals of a Chinese company, you're not necessarily looking at GAAP numbers. You're not
Yep.
looking at generally accepted accounting principles. And they're supposed to be the same, right? They're supposed to be similar. But the Chinese do have different accounting standards. And sometimes that's been known to be viewed as more of, there's a lot more financial shenanigans going on in Chinese financial statements. So you just have to be aware of that. I mean, just look at if you need an example, right? Just look at
Okay.
Lucky and
Yep.
right. These guys, like, they were literally just making up their sales.
Yeah.
So, and that type of thing can happen when they're able to get away with it. If you could get away with it in the United States, there would almost certainly be companies doing it here as well.
Yeah, and
Just,
unfortunately,
there are
unfortunately for me, LK was a company I was investing because it was hitting all those marks of a great growth, and obviously we ended up finding out that they were hitting those great growth because were doing their fake false numbers. But at the end of the day, because of my portfolio breakdown, it wasn't. I took a loss, but it wasn't that big of an impact. And some people might say, "Hey, Jose, with obviously you're not gonna get hit hard. So when things go up, you're also not gonna go up." And that is completely wrong, in my opinion, right? Because I have positions that have been probably 2% of my portfolio and now are about 6, 7% of my portfolio based on that growth. They can only lose 100% of your money from it, but they could become a 10 bagger, they can be a 20 bagger. So that growth is definitely there.
Yeah, absolutely. Okay. Another question from Dr. Chan the man. Concerning vaccine companies and pharma companies developing COVID-19 vaccines, is there a way you would recommend how to filter and identify companies that have the resources to produce and develop the vaccine and profit from it from only a financial standpoint?
From only a financial standpoint, I don't think you can really get that much information. But I'm not in the vaccine game. I'm not in biotech. Usually biotechs are companies I stay away from because if I can't even pronounce what they're selling, I'm pretty sure I'm not gonna understand what they do. Um, but I do
That's a
think,
really
but I do think looking at their balance sheet, for example, to me, my favorite, my 100%, my favorite document to really look at is their balance sheet. If they have a nice amount of cash and they have very little debt, then it might show that they might be doing something. But again, that's all. It doesn't tell you anything at all. It just tells me that, hey, these guys have money and they have no debt. But that would be the closest thing to that question, I would say.
yeah. That's what I was going to say too. Definitely the balance sheet. Know that in the biotech industry, so there's a cycle that happens in the biotech industry. You have a whole bunch of investments, right? You do the IPO, you get a bunch of investment, you go through preclinical and phase one clinical trials, you announce the results of the clinical trial. If it's positive, right, then they pump the stock price up 100% because everybody overreacts to the news. And then within 2 or 3 days after that PR comes out about positive clinical trial results, they do a secondary offering to raise more capital. And they use that capital to then invest in the second phase of the clinical trial results. And that process continues, right? You go through preclinical, phase one, phase two, phase three, and then you have FDA approval.
Hmm.
So the sequence of PR, pump up the stock price, do a secondary offering to raise more capital, spend all the money on your next phase, do another PR, pump the stock price up, raise more capital. That's sort of a cycle in the biotech industry that I picked up from a trader that I stayed with back in 2014. And, he sort of taught me this. Well, he was a real big biotech investor. Um, and one of the things that he also said to focus on is their burn rate, because if they can get through all three phases plus the FDA approval without diluting the stock too much, right, by constantly selling more shares in order to raise capital and pay for their clinical trials, if they're good with their money and they have a low burn rate where they're not burning a ton of cash to get through each one of those trial periods, and they're going to last a lot longer. So cash is everything when you're an early stage biotech company.
Agreed, and I do think the cash flow statement kind of, especially in the red flag analysis, the cash flow statement here helps you see, hey, how are they doing with their cash, with their operating cash flow, with their free cash flow? Is most of their money coming from just investing and selling stocks? So I do believe a lot of that can be seen in this portion of Lazy FA. And that's why for me, Chris, this has become my favorite sector, the red flag analysis.
Well, I can tell you it was definitely my favorite piece to build because it was so much fun trying to automate digging up dirt on a company. All right, so there's a few more questions here. Are you okay on time?
Oh yeah, 100%.
Okay, because I don't want to be here all night, but there are still some questions, so I want to try to get through them. So Dark Appalachian had asked, I speak with new traders and investors. One thing I always suggest is to compare multiple evaluations of a company. Examples are evaluating and comparing different ratios from fundamental analysis and different indicators from technical analysis before making up your mind. Do you agree with this sentiment, or do you think young investors and traders can get a decent idea about a company and what direction it's going using only one or two evaluations versus dozens? So
So
hopefully
I,
that's clear.
I agree with them. I do believe, and that's why I said earlier where it's important to try to learn something from different investors. So for example, a growth investor might not really care much about valuation. They might not, but then if you talk to a value investor, they might show you certain ways that they valued their stock. So now if you do certain valuations from growth stocks and if you do certain valuations from a value stock investor, now you can really see more of the picture from different valuations of where things are going. So I do agree that looking at multiple valuations it is a great way, and just to become familiarized of what those valuations mean.
Yeah. Okay, cool. I would agree with that too. And Dark Appellation, the other thing that I would say is I think that there is, and I bet Jose will agree with me here. I think there is a limit to that because
Agreed.
at some point, yeah, like at some point you end up in the paralysis by analysis situation. Uh, um, at some point you just got to make a decision.
Yeah, that's a hundred
So
percent true. And then there's certain valuations that even though they might have different names, they're just a better version of another one. So try to find that
mm,
one better version. For example, there's price to sales ratio, then there's EVS to sales ratio, then there's EVS minus blah 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 to sales ratio. So try to find the one that you like out of all of those that kind of have similar values, and pick that one, and then go to another one that chooses maybe different metrics, maybe another one that chooses just that's doing valuation based on growth, or based on everything else.
yeah, yeah. Sure. All right. Do you think investing in a company at any point is worthwhile and then averaging down until the bottom is reached? Or is it better to evaluate, try and get the bottom price and average up versus just jumping in? So I think what he's asking here um, is it better to just jump in and then if you're wrong, average down until you find the bottom? Or is it better to time the market and then average up?
um for me, I don't time the market. So for me, if it's a company I already know a lot about, and if it continues to drop, I would periodically buy into it. One example is during this crash during March, this crash in March, where we were seeing multiple days of 3% drops. Imagine if you put all your money on the first 3% drop, then you're pretty much screwed out. So what I did, I think I had about during that time I had about 10,000, around 10,000, let's say, that I was able to put more into the market. So what I decided was every time we had a 3% drop, I would put 1,500 into the market. If we had a 5% drop, I would put maybe 1,700 or 1,800. So this allowed me to continue going that drop and not waste all my money at once. And the reason I did it like that was because I didn't know when that bottom was going to happen. So I didn't want to risk myself. And again, this comes with that risk tolerance. I did not want to risk myself of just waiting for the bottom and missing it. And I would be okay just
with this, I put I set an amount of cash that I would put into my stock account, extra stock account, and I would add in on certain rules. So it helped me diversify over time and over drop.
Definitely. I agree with that 100%. It's especially if you're long-term investing, it does not make sense to average down when you are an active trader. If you're a swing trader and you're only going to hold the stock for a week or even a month, averaging down, you just don't have enough time to recover. So you're only going to dig yourself into a pit and you won't be able to get out of it. So for me, with short term trades, it's just either it works or it doesn't. Right? If it doesn't
Yep.
work, you bail, you take the loss, you move on. Trading is a numbers game, right? But investing is more of a time game.
Agreed. And that tolerance that I mentioned on the way down, I even do it the other way on the way up. Sometimes you might be like, oh man, I only bought a small position in this company and I just see it skyrocket X amount of percent. In that same position, I do the same thing. I look at how much cash I have. If I have extra cash, I'd say I'm gonna buy in at every X percent. I'm not afraid to average up as well. But just I'm not gonna put all my money on the first going up day, thinking that I'm just gonna miss out the whole rally.
Yeah, yeah, definitely. All right, cool. I think we got one, two, three, four more questions. That's that's cool with you. So number one, does your evaluation method using Rule of 40 work on non-SaaS stocks? Does Rule of 40 apply to EV stocks, for example? I'm not. What's the Rule of 40? Is that a thing that you do,
So
Jose?
I've started doing these videos where I do a form of valuation method, and there's pretty much how someone else was talking. I mentioned different valuations. I take a look at multiple valuation methods. So I take a look at enterprise value to sales ratio, and I also take a look at a Rule 240 valuation method. And the Rule 240 valuation method is this method I learned from SaaS company from that people use for SaaS companies, where they pretty much add add the company's revenue growth plus the company's profit margins. And in theory, if this is higher than 40, it kind of tells you that, hey, this is a company that's doing well. Unfortunately, that rule of 40 does not only takes in account growth of revenue and only takes account profitable margins. It doesn't really take account anything regarding to the price to sales ratio, anything regarding to the market cap. So what I ended up doing is I ended up putting the rule of 40 together with the enterprise value to sales ratio. If you don't know the enterprise value to sales ratio, that takes account the company's market cap, the company's total debt, and quick assets. Also, it takes account total trailing 12 months revenue. So by me kind of mixing them together, it gave me kind of a valuation method. And obviously this is just quick math. It's not, I'm pretty sure there's a better way to do it. But it kind of takes in account now the enterprise value, revenue growth, profit margins, and the past revenue. So I kind of get a better picture. And this helps me kind of, and now that I have this valuation method, I kind of use when looking at similar companies. So on my clouding companies, I use it because they're all within the certain market. So just with any type of valuation method, as long as you use it with companies that are in the same market, I think that's where it's the most beneficial at. If, for example, you take a look at a gaming company and then you take a look at the at an automobile company and you try to compare them based on those valuations, they don't make any sense because they are in completely different markets. So
Yeah, yeah.
any valuation method that I use or I do, it's always on similar companies because I feel like that's where you get the best. It might not be the perfect, but that's where you get the best kind of understanding of how they're valued amongst each other.
Got it. All right. So there are two more questions, and I'm going to reverse them because the first one is actually a really good question to end on. So the first one is, if one was willing to study in their mid to late 20s to get a better understanding of the market, what courses would be taken to get a great understanding of profitable investments in shares in a 1 to 2 year gap? Any advice on courses that people could take? I'm guessing you mean like college courses, Frosty. Is that accurate? I probably have to wait for a response,
Mhm.
but what's your initial thought to that question?
So to me, if he means just a way to understand the market in about 2 years, I definitely want to say it depends on again, everybody is different. It's first try to understand how you best absorb information. So for me, I really absorb information through reading books. So I'm not much of a listening through audio in regards to books. So there's a few books that I really enjoy, and that I constantly go back into, even now that I feel like I've developed more as an investor. So I personally like learning through books, and I wouldn't pay courses. I wouldn't pay courses or go online to try to not. I wouldn't go to a college course to understand more about the stock market. I feel like there's ton of information in YouTube. There's ton of information in books. There's tons of podcasts that you can listen to that will help you learn the overall market, as long as you have the time to learn.
Yeah, yeah, definitely. I agree also. I think that I, I'm more of a more of a modern philosophy when it comes to education. Um, I believe that there's not really anything that you can get in college that you can't get on somewhere on the internet for free. You just have to have the motivation to go out and find it. Um, some of the things that I took in college that I think were helpful, at least in terms of fundamentals and understanding uh, company valuation, were courses in corporate finance. Whether or not it's a course that you take in a school setting, or just listening to podcasts or looking up YouTube tutorials or uh, online courses or whatever, right? A whole bunch of different options out there for stuff like this. But I found that understanding corporate finance and understanding financial accounting, and how these companies can sort of game the systems with their financial reporting. Me, was that was really helpful, and at least being able to read between the lines, which I think once you get past the point where you are, Jose, with being comfortable and having sort of a routine with going through the investor presentation and teaching yourself about the industry and learning about the company's competitors and so on and so forth. You make an investment and then some bad news comes out and you have to figure out if this is significant or not. That's, in my opinion, where it really comes in handy knowing how to read between the lines, because these companies are not going to come out and tell you
Yep.
ever. They're not ever going to come out and tell you that shit just hit the fan and we're about to go bankrupt in
Hmm.
3 weeks. They'll never come out and tell you that, right? It'll always be buried in a footnote, or it'll be some obscure thing that they didn't even PR. They just put it out into an 8K report and never mentioned it. And that they just do it because that's all they legally have to do. Um, Understanding corporate finance and like looking at the potential pitfalls from that perspective, I think is really good stuff to know. Even if you don't use it right now, I think it's just good to know, to get a better understanding of what the possible risks are.
Definitely agree.
All right. So last question. Here it is. If there was one bit of advice you could give, there's one bit of advice you could give out that you would hope people really understand and focus on, what would that piece of advice be? I
So
think that's a good one to end.
yeah. So here, this is. I'm probably gonna sound like a broken record, but to me, the number one thing to really understand is just understand your emotions in this game. Understand your risk tolerance. And once you understand that portion, it's gonna help you a lot, because once you understand your risk tolerance, it tells you, hey, how much are you willing to go into a position?
Hey, how much are you willing to invest in certain country? Hey, how much are you willing to invest a day? How much are you willing to invest on the week in the week? So once you understand your risk tolerance and your own psychological thoughts within how you can handle certain days, it really opens up so many new doors for you in this investing world.
Yeah, absolutely, man. I 100% agree. Whether you're talking about long-term investing, swing trading, day trading, anything that involves money, right? Because in reality, I mean, let's be realistic. We're calculated gamblers.
Yep.
There's no other, there's no other way to really put it, right? The way that I look at investing and trading in general is sort of like going to Vegas, right? Because in Vegas, you can go and play the slot machines, but the slot machine is always, tipped in favor of the house. There's no strategy in playing slots, right? It's just put your coins in and you pull the thing and either you win or you don't. And it's biased to make sure that you don't win, right? To make sure that the house always wins. But with a game like blackjack or poker, there is strategy involved in it. So while it's all technically gambling, there are ways to calculate the risks and to put the odds somewhat in your favor. And that's how I look at investing also. Understanding your emotions and being able to put the odds in your favor, I think is so important. But you just have to understand that we really are calculated gamblers. We're making calculated risks, and we analyze the risk and the reward, and we try to make it so that the reward always outweighs the risks. Because that way, even if we lose more than we win, we're still going to make money in the end.
Yeah, definitely, Chris.
Cool. All right, man. Well, listen, thank you for sticking with me for almost an hour and a half. This is, I think, the longest stream that we've ever done in this Discord. Usually it's about an hour. But this is by far the longest one, which is good because last time I did one, it was only about half an hour. So now we've averaged out between the last two to exactly 1 hour, which is what I like.
Dollar cost averaging.
Yeah, exactly. But Jose, seriously, man, thank you so much. This has been enlightening for me, even as someone who's been involved in the markets for a really long time. I love hearing other people's strategies and just other people's outlooks on the market. I love how you sort of look at everything as an open book, and that someone can always teach you something. And I think that's super important, right? To always keep your mind open with this. And there tends to be, at least in my experience, there tends to be a lot of competition in the market. Like I'm right and you're wrong, and my strategy is the best, and that's it. I think your philosophy and your outlook on this is going to take you a lot further than most people.
Thank you, Chris. That really means a lot to me, and it was pretty good. I mean, I've emailed you so many times, giving you like, hey, maybe I want this cool feature on LazyFA. Do you think this has time? But I don't think we've really ever sat down and talk, and this was pretty good. And I hope to the viewers that I did provide some form of value to you guys. And thank you guys for taking the time to watch this.
Yeah, absolutely. Thank you definitely to everybody who's in here. We also, I think, had a record number of people that were watching. I don't know if Discord, how many were in here total, but like Twitch will send you a summary that tells you how many people were watching at the most. But I had to scroll pretty far to get to the bottom of the list. It's more than I've ever seen in here. So we'll have to keep that in mind. Maybe we can do this again another time. And
that'll be good. Stocks is one topic I can take all day for.
Nice. All right, man. Well, so guys, once again, Jose Najarro from Jose Najarro Stocks. Look him up on YouTube. Seriously, he pumps out videos like it's going out of style. Like every day I look at him like, how do you make so many damn videos? Because like I can't even make one a week, and he's churning out 5 or 6. So check him out 100%. He's got some really awesome stuff out there. And Jose, thanks again, man, for being here and for all of your insights.
Thank you, Chris. Take care, everybody. Have a good night.
All right. Take it easy, guys. Peace out.